Hello, good evening, guys. Welcome back. And hello, Chunbing. Nice to see you again, and everyone else. So yeah, today we are going back to Malaysia. At least for our Not So Late Night show. And I hope you guys who are in Malaysia are coping with the situation, still healthy and safe. And today's company, it's a Malaysian company. Yeah, we go back to Malaysia, and this is actually one of the companies that one of you guys, one of our readers or fans has actually suggested us to take a deeper look. So as always, if you have any companies that you want us to, do a deep dive or do a sharing every Thursday, and you want to spend your Thursday night with us, then yeah, you can shout out the company in the comment section, or you can also PM us, or yeah, whether you are watching it from Facebook or even the YouTube, or even through Instagram as well. We will take a look at it, and if it's interesting, then yeah, definitely we will put in some thoughts and efforts to study the company, and then yeah, every Thursday this is where we do our stuffs, and we can also treat it as a platform where you guys also can share with us if you have any knowledge and insight of this company. The company is UEM Edgenta. So I previously also never knew about this company. After studying it, only I know this company is actually a leading infrastructure service and healthcare support company. Later, we will go deeper into dissecting and explaining what does that mean. But from the background picture, you roughly know this company has something to do with constructing, maintaining, be it or could be building, could be highway, because there's buildings and highways at background there. But later we'll go into deeper on this company. And yeah, you can also let us know whether you know about this company or not, and what you like about this company. Are you vested in this company or not? And of course, you can also ask us any non-Edgenta related questions, since we are living in a times where a lot of things are happening around this world. If it's regarding investing, and if something we can give our opinions and you value our opinions, then by all means just shoot us the question. So yeah, I'll wait for Chunbing to give me the cue to start into today's topic of the day, UEM Edgenta.
We can start the session. Yeah.
Okay, so here we go. UEM Edgenta. You can see here from the title itself, it's one of the members of the UEM group. We also talk about a little bit on UEM group itself later. What is the connection? Of course, before we go in, just a quick advertisement. We are running our Stock Plus 2021 this coming weekend, 30th and 31st of January. It will be 2 whole days, and it's still open. If you are interested, you can catch us. Those who have actually enrolled, they have received our Stock Plus report already, Stock Plus 2021, and they have gone through all the 10 companies. For you guys who have enrolled, please get ready your questions. I know that you have a lot of them. We will go through. You can catch us those one seminar, one company, each of them deep dive, and then we will answer your questions if you have any. But yeah, here's just a snapshot of the performance. So it has been a very good market, at least for the companies that we highlighted. There are some red there. Of course, and we are not perfect, but there are some really tremendous, surprising gainers in our portfolio. So yeah, if you still want to know what are the components you want to join us this weekend, just sign up at the comment section. We will put a link there. So back to the main character of the day, UEM Edgenta. This is the disclaimer as always. It's just a sharing. Do not take it seriously until you want to make your investment decision just basing on what we are sharing today. So this is just what we are sharing, what we have found out, what we know, and then it will also come with some opinions whether we like the company's business model or not. But at the end of the day, do your own due diligence, and we hope you all the best in finding your next investment opportunity. So UEM Edgenta, this is a company where it is related to the infrastructure service and also healthcare service. And what do they actually do? But before that, we just talk about the company itself. It is one of the largest total asset solutions company. It is a member of the UEM group. It got listed in the Malaysia Stock Exchange in 2017, 30th of August, and they have multiple business services. So going to what they actually do. So basically, this company is in 4 business verticals. The first vertical being the healthcare support. So they are in healthcare, surprising. I didn't know that previously before I studied it. They're also in property and facility solutions, meaning they help to take care of the buildings in terms of the electricity usage, the water usage, the waste management, and also whatever efficiencies that you want for building. You can actually liaise with them for them to provide a solution. So they're also in the infrastructure services. I think this is one of the business that I'm more familiar with. Basically, they help maintain highways, which they are in charge of. And then there's also asset consultancy, where they can also be one of the key parties when it comes to managing mega projects. Say, for example, new highway, new high-speed rail, etc. These kind of examples. So we go deeper into the first vertical, which is the healthcare support. I'll pass to Chun Bing to go through all of Edgenta's business verticals, and then we'll go into the numbers next with me taking over. But hit it away, Chun Bing. What does Edgenta actually do for its healthcare support?
Yeah, so I think the keyword is healthcare support. So they are not into the healthcare line. They are not providing the healthcare services, but then providing more of the support in terms of facilities. So this is all the key steps that the company has been providing the service to. I think the key one is 300 over hospital. But what they really did is they're dealing with all the if you enter a hospital and then go through some operation or whatnot, there will be a couple of things that need to go through some sort of cleaning process, or you need to, technically in layman terms, to burn it because it's hazardous or whatnot. So
incinerate, yeah.
Yeah. So UEM Edgenta is the one that providing and doing the dirty job, outsourcing, as in all the hospital outsource all these services to them. And then you'll be quite surprised. I mean, this kind of services is actually plugged under something called UEM Group, because for most of us, we will think UEM is a construction company focusing in property development. So this is one of the things that quite unique, but then it's basically providing some sort of professional cleaning services to hospital-related facilities and so on in layman term. But then if you want to go deeper, you can actually go through the annual report and find out a lot of info. But then if you just wanted to get a shot on it, on what they really do, this is the simple version of it.
Cool. So we also talk about they are in the property and facility solutions vertical as well. So under this segment, what do they actually do?
Yeah, so when we write the key title is property and facility solution, in short, they are like the one who manage the entire building. Of course, this is all the key steps that they manage to do from all the building that they manage. For example, they can actually help to reduce the electricity consumption for certain buildings. And you can think of it easily is because they are linked to UEM. I mean, a lot of things that is actually contract given by their owner in a way, and then for them to just do the management of it. And then, of course, also thanks to all the pushing or all the initiative by the government for green building, they also into something like this. But then this is not really a key business pillar for them yet.
Okay. Later we'll talk about which are the key business pillars for UEM Edgenta. But before that, we go on to the third vertical, which is infrastructure facilities. I think this one most of us are more well versed with, which is one of their main pillars. So under this segment, what do they do?
Yep. So you might heard of UEM Sunrise. Then they are property developer. They build condos and whatnot. A big chunk of UEM group, they actually provide, as in they build highway or expressway inside the Klang Valley or the North-South Highway that most of us use, as in familiar with. And then the maintenance work of it, they actually give to this company called UEM Edgenta. And then they are into this field for very, very long, even though they got listed like 2-3 years ago. But they has been providing the services for 30 years. And of course, there are a couple of highways serviced by them. But then I will go into details. The key one is North-South Highway is serviced by them. And the rest is actually most of the highway built by UEM is also serviced by them.
Yeah. So fun fact, Penang Bridge also is under them also. So they service a lot of big, long highways. Last but not least, asset consultant. So what is asset consulting, and what does this company actually do in this segment?
So based on their experience dealing with all these development of services, they managed to spin off one of the business vertical by providing consultancy to all the people that is interested in building highway, for example, or managing buildings. So this is a group of people that has been selected, so that in their case, they got about 400 professionals employee. They're providing consultancy services for all the new player. Let's say people who who gotten the contract of building a highway in, let's say, Sabah, Sarawak. And then they might need consultancy services. So come into this space and help them. So instead of building and maintain, instead of maintaining the thing, they also provide a consultancy on how to do all these things. A small chunk of it.
Yep. So we talk about how these companies surprisingly have 4 business verticals, but out of these 4, which one is the most heavily contributing to UEM Edgenta's top line and bottom line?
So when you see this, you can differentiate by the color. The blue color is actually on healthcare support, the one that we actually share on business pillar number 1. Surprisingly, it covers almost half of it. And then the consultancy and also the property and facility solution is a small chunk of it. You can see in the green color or light brown color. And the one in orange is actually the one most of us are familiar with. It's the maintenance works that provide to highway and so on. So this build up the entire revenue stream for the company. But one key question that you should ask is, when the company that's in multiple business pillar, you need to think, are they sort of interconnected? I mean, this is like one of the key factors for you to judge whether you should proceed with this company or not. But of course, in my personal opinion, I don't think it's linked. For them is beside all the consultancy that's providing small chunk of revenue into it, healthcare and the another 3 is totally not related. So they can't really have a synergy in it. Cannot create 1 + 1 equal, I think, greater than 2. So this is some of the drawback of the company.
So I think this is quite similar to one company that we talked about previously, which was Syntex. So Syntex, we previously talked about in packaging and also in property development. 2 also tak link, no synergism, but yet the company still grow. So is UEM Edgenta one of these examples of company, different business segment vertical, but still be able to grow both verticals together? So we go to the numbers, the historical financial performance of UEM Edgenta. So from here you can see this is by quarter. You can see that by quarter the revenue actually is flattish, and the past few quarters where we were actually being hit by the pandemic, so the revenue actually inched down. So what happened? So you can see during their so-called most promising quarter, which is quarter 4 2019, they said that they have high revenue from asset management and also the infrastructure solutions, and one-off provisions made for receivables. So during that time, which was before COVID strike, they were actually doing a lot of projects and also the asset management portion, so that actually push up their revenue and also one-off provision made for the receivers. That's why you can see the profit margin actually from 2%, 5% historically went up to 13.7%. So looks like a reversal in terms of trend and the potential turnaround for a company. But come to Q1 2020, that was the start of the pandemic. Then the revenue actually slid down. Came down a lot. Decrease in revenue because from asset management and also the infrastructure solutions, and then there's a margin contraction. That means cost increase, and then they still have to pay out certain worker salaries and certain expenses, and then due to that, the margins actually contracted up from the height of 13.7% down to 2.2%, which was its previous previous average profit margin. Then come to even the worst part or the climax of the pandemic, Q2 2020. So further increase in operating costs. So the cost actually increased even more. And then they have to recognize some impairment because during that period, I think most of the infrastructure works and also most of the construction companies were actually hit hard back then. So you have to factor in all the impairments, all the losses that you might have incurred, and then it slid into negative profit margin. And then it was also during that time, MCO, there was less pavement work done. So this company was actually badly impacted by the MCO since their business was considered not an essential service. But you also remember that there's also one part of it, which is the healthcare sector, or healthcare service support. So you don't see that healthcare support business or vertical actually helping to sustain the entire operations. In fact, just because the ratio of the healthcare services and also the construction or infrastructure management services was quite equal. So a heavy hit on the infrastructure service portion or the segment actually dragged down the whole entire company's profitability and also the revenue as well. And sometimes people say that company fundamentals can predict the share price movement. So you can see it's quite true lah. We draw a line 2016 here, and here is also we start the share price movement also at 2016. The company share price went down because quarterly the company actually was reporting lesser and lesser revenue, right? Then back in 2019, some sort like a kind of a rebound or reversal in terms of the performance. So 2019 here, you also see that, oh yeah, looks like a company might have some rebound or reversal in terms of prospects, right? Then after that, when the pandemic came, boom, it just went down lower and lower. And as of today, 2021, this company is hovering at its 5 years historical low, which is 1 ringgit and roughly 1 ringgit and 70 cents per share. So now that we know that this company got impacted by the pandemic, let's look at the other aspects of it, which is the balance sheet. Can this company actually survive a condition if pandemic were to continue, or if, let's say, MCO is actually extended? So you can see from the assets portion itself, the assets are actually dropping. Then that actually spells a little bit of concern for me, because if you look at, or if you try to see the business once again, this company relies heavily on assets. Say, for example, you want to pave the road, you want to repair roads and highways, you need to have a fleet of vehicles, lorries and whatsoever. So you need to spend money to buy all these kind of equipment so that you can repair more roads, pave more roads. So if your assets is flat, that means that the current assets that you have on hand is actually not growing at a rate that I might presume the company will grow in the near-term future, right? And it's flat. So what they have now, probably they are not spending more in terms of capex. And then we move on to the other portion of it, which is the equity. The equity part also has been decreasing. We also saw that for the previous few quarters, Edgenta actually slipped into a loss. So when you lose money, you are losing the shareholders' profit that has been accumulated all along the years since the company was operating. So when you lose money, then of course you lose away some of the total retained earnings, which is earnings that is attributable to shareholders, and that also will pull down your total assets as well. And last but not least, you can see the cash portion is also trending downwards as well, because you lose money, you need to pay out more money, definitely your cash portion will be impacted. So you can see from the balance sheet itself, this is the kind of a scenario or the trend that the company is currently undergoing. Next, you go to the cash flow statement. Sorry, this should be the cash flow statement. You can see that the cash flow statement of this company is rather flattish lah. So for at least for the past few years, it has been around 200 plus million, nothing more, nothing less, because your business also have been flattish, so your cash flow will not increase that significantly. And you move on to the financial portion, you see that financial is quite consistently on the high side, because this company is a dividend paying company, meaning to say that if it's earning a profit, it definitely pays out a portion or huge portion of it in terms of dividends to its shareholders. And you might ask why, since if that's the case, if this company is so predictable in terms of its dividend payment, should I be considering into investing in this company if I want to buy into a dividend counter? So taking a look at who actually owns UEM Edgenta from the list of top 10 shareholders, you can see on the top side, number 1 position, you have UEM Group Berhad holding a stake of 68% of UEM Edgenta. So this is a company owned by UEM Group. And you also need to ask the question, who owns UEM Group? If you dig deep enough, you actually find out that all the UEM companies, be it UEM Group, UEM Edgenta, and also Sunrise, they are owned by our Khazanah Nasional, which is our sovereign wealth fund. So it makes sense to actually now see that this company, why this company actually channels most of its profits back as dividends, because ultimately Khazanah is a fund house, is a national fund house. They would want to maybe reallocate that fund or the cash or the earnings into more profitable business, or to do whatever investment related activities that they want. So it makes sense for their listed entities to actually pump back any earnings or dividends back to the holding company or the owner of the company, group of companies of UEM, which is Khazanah Nasional. So now that it makes sense for the company to pay out more dividends, should you actually invest in it? But before that, let's gauge on the prospects and the risks of the company. How prospective is this company in terms of growing its business, and what are the risks that you might need to take note of? I'll pass it to Chun Beng. What do you see as a prospect for this company to actually continue to grow its business and then eventually pay out more dividends?
Yep. So I think the very straightforward answer for this is actually they are government-linked companies. Like what Jupan has shared, eventually the bosses behind the scene is Khazanah. And then this assure you with the dividend return in some way. You may link it that way. But of course, on top of that, they are coming from multiple verticals. Theoretically, for all the business that is in multiple verticals, they can help each other. If the synergy is there, then that's better. So let's say you have the services of catching the fish, and then eventually you are selling the fish ball. Then this one makes sense, because you will be able to control the raw materials price. So, but for this case is we haven't really seen the direct link between the healthcare versus the infrastructure services, but nevertheless, infrastructure services actually help to support another two business pillar that is contributing in a slightly smaller numbers, which is the properties and facility solution, and also the consultancy. I mean, that part is a good one. And of course, the next one is a service oriented in a way. Promote you consistency. Usually go with one guy for the service, you continue with it. And if you think of it, the services services contract come from your owner. So going to be a way lah. I mean it's very consistent in that way. So this is all the prospect from it. Despite the number might not be looking very, very well for the recent quarters. So this is some of things you should take note on their future prospect. But then there's also a few key risks you should really take notes. Same goes to GLC. It can give you contract, can give you services for years, but then it might be the stopper for you if you wanted to grow further. There will be a lot of factors, maybe political driven and whatnot that you cannot predict. It can be something like black swan incident happened that you don't know. Suddenly UEM got chopped off for providing all these services. We won't know. But then I think this is not the key risk. The key risk is actually they are asset intensive company, which is very different with a lot of company that's providing a lot of good growth stories. Asset incentive means you provide facilities, you buy machines, you buy trucks or whatnot. Every year you need to suffer the depreciations from a financial perspective and from a reality perspective as well. It really will depreciate. And depreciate is just one thing, meaning you buy this truck and then a few years later might need to send for more maintenance because it might break down more frequently. Another track is it might be outdated. Then you need to spend a capex to come with it. So the cycle keep on repeats. But if this thing provide use with high margin return, that's okay lah. I mean, I spend 500 ringgits and then I can earn 2,000 ringgit in 3 years. Then I keep on repeating it. Then the margin is still very high. So let's say it's 1,500 over the 500 ringgit spent over 3 years, still fine, you know, in a way lah. But then if you see the number that's we shared just now, the highest that have ever go for margin is 13 to 14, which is a one-off thing or one-off contract granted to them throughout the years. If you can monitor, they used to be slightly okay, but then it's on a dropping trend, unfortunately, which is very different with Scientex. Scientex profit margin is not very high, but then it's predictable, and then the new verticals that come in really help them to boost up the profit margin from an overall perspective, even though not linked, but then from a company perspective, their profit margin is on an uptrend. So all this is the risk that is happening in UEM Edgenta compared to Scientex that's relatively stable and more promising in that way.
Yeah. So I think very fair picture painted for UEM Edgenta. So last but not least, valuation of this company. So you can see that this company, due to the intensive assets nature of the business, it means that if the company needs to grow, they want to pave more roads, they want to repair more roads, they have to buy more machineries, buy more trucks. So when all the depreciation comes in and kicks in, and you factor in the so-called loss in revenue that they have experienced during a few quarters, you can see that the ROE is just at 4.31%, so it's very low. They have to factor in the quarterly losses they incur for the past few quarters. PE definitely will. Primarily the PE is still on quite a high side. But if you look at the dividend yield, right, you see that they have a dividend policy. That means they have a 50% dividend policy. For every 1 ringgit this company earns, they'll pay out 50% of it. So that jives with the cash flow activity that we see that, how come this company earn this much, then almost, if not a big chunk of it actually goes pay out as a dividend, because there's a dividend policy. And then when you study who is the actually holding company or the owner of Edgenta, you understand or give a reason that why the company is actually quite generous when it comes to paying out dividend. But you also know that this company has been impacted quite heavily or quite badly by the pandemic. Now you have another MCO. Hopefully this one wouldn't be a long and suffering one. But nonetheless, their tasks or their jobs when it comes to the pavement infrastructure kind of services definitely will get impacted. And when the share price tank, and you take the trailing dividend payout and you divide it by today's share price, which is at 1 ringgit plus kind of valuation, you get the high dividend yield. And if you are going to buy a company just based on the dividend yield, you will be getting into a trap, just because that past historical dividend payout over today's price is giving you a very enticing 8%. But after going through the business and knowing that this company is still trying to recover from the current pandemic, where their activities or their main revenue generator got hit really hard, definitely company will still need time to actually recover from it lah. So yeah, that's it for today, for today's company. Four verticals, but relatively easy to understand and relatively easy to find out what is good, what is prospective, and what are the risks that you should actually take note of should you want to consider UEM Edgenta as one of a component in your stock. So I guess that's about it. We will be going back to the questions that you guys might have been posted in the comment section. David LKF is asking, is AWC one of its peers? AWC, let me do a quick check. I also a long time never follow up with this company maybe. Used to be a hot stock back then, AWC. Yeah, I think in some verticals, you can consider AWC as a peer with UEM Edgenta, but I don't think because UEM Edgenta has in 4 verticals, right? So I don't think AWC also is competing with UEM Edgenta in all 4 sectors. Next, NG. Do you think the political instability in Malaysia affects the share price as well? Okay, this is purely my opinion. And if you were to study how Khazanah Nasional is parked under our so-called government, correct me if I'm wrong, Khazanah Nasional is parked under MOF, Ministry of Finance. So you might argue that yes, due to the current political condition in Malaysia, it might somehow impact Khazanah. But ultimately, if the current ruling party or the new ruling party will take over, Khazanah will still be generating returns or investment returns to the whoever that becomes the Ministry of Finance, right? So they might change a few key individuals managing Khazanah, political kind of appointments, but at the end of the day, whatever stays inside Khazanah's book will still be Khazanah's assets, right? It's just like new guard or new management or new politician, whether they have a change in direction of investment thesis or investment horizon. So it shouldn't be that greatly impacted by the political instability, but more on whether the government has the coffers or the money to spend on projects. So that one would be a better question to ask if you want to put a bullish thesis on UEM Edgenta. So if the government don't have money for mega projects, then of course, companies like UEM Edgenta would not have potential additional revenue. SV is asking, do you see the trend of outsourced facilities management growing in Malaysia? I think it depends case by case. There are already some segments or some sectors where you see outsourced facilities management is growing. Oil and gas, I think there are a handful of companies which are outsourcing, or they are the so-called outsourced parties that are handling all the operating and maintenance, EPCC. So there are a few of these examples already in oil and gas. But for repair in terms of railway, highway, I don't see the trend yet. For at least for our normal roads and our highways, not as developed as the oil and gas segment. Okay, I think there are still some questions on Edgenta. So NG is asking again, do you think as a long run they remain as monopoly, it will be fine for them? This is also one of the questions I asked myself, also NG. Basically, this is a company, if they want to grow, they have to find more hospitals to service. They also have to find more roads to repair. So when I think of this aspect, okay, the hospital one, straightforward lah. You manage to find a new hospital to service, then yeah, you actually grow revenue. But if you find more roads to repair, do you want a infrastructure service company to keep on repairing the same road and then give you very good results? But from a road user or from driver perspective, you see like, how come this road always need to repair? Something must not be right? So you want to strike out a balance where, yes, you need to repair, pave your roads, but you don't want that road to get into such a frequent repairs, because as we know, when a road gets into repair or new paving work, it spells out longer jams, and the road might not be in a very nice condition to drive in. So you have to weigh out the so-called balance it out. How frequent is it okay for infrastructure service companies to pave and to repair a road, and whether you are vested in the company, how would you want the company to grow in this segment? So I cannot be asking UEM Edgenta to pave the north-south highway every year, pave the whole north-south highway one time. So that would be unrealistic. Certain portion of it, yes, and then you go back to the so-called north-south highway or the federal highway or the Penang Bridge. So you have to weigh out an equal balance point where whether how frequent is possible, and with that frequency, do you foresee the company to grow based on the services that it's providing lah. So I hope I answered your question. So based on that, I would say that, yeah, I don't like the company to be that frequent paving the road just because it can grow the revenue, because I don't want a road keep on being repaired and paved if it's the road I am using on a daily basis. But if you think if it remains as a monopoly, there's an upside, then yeah, you do have a point as well. But do your further studies and validify your claims before you actually consider investing in the company. Next, Adrian Chong is asking, can do Masterpack one of these days? Okay, Ken, I think Masterpack is an interesting company since we previously cover some of the packaging companies. So Malaysia, we have a lot of packaging companies. So yeah, worth to actually look into Masterpack as well. Yeah, you can keep the questions coming, but other than that, Chun Bing, anything you want to top up or share while we wait for the new questions to come in?
Yeah, I think one of the things to top up is usually during economic downturn, there's a time where government will come out to do something, and usually it means a mega project will be coming, in theory. But then this time around it's a little bit different, because the government literally need to spend money on other things on top of economic recovery. So the theory of economic downturn equivalent to more mega project to give more job or more cash injection to the private sector might not be true this round. So there's something to take note lah. Of course, based on past experiences, usually it's that way, but this time around might not be. So need to be careful for when you wanted to invest in this company lah. Yeah. Chupan, are you still there? Okay, we'll continue with the other question. Okay, thanks for the feedback, Angie. And then I think, David, this is like echoing what I'm trying to say just now, which is also on the fact that the government's actually spent a lot of money during the pandemic, and then this might not be a plus point for UEM Edgenta in short-term perspective. Okay, we have another last thing. So as we are asking about this question called the impairment impact that's reported. So I think in general term, impairment impacts means they have incurred losses that they cannot recover because, let's say, they have an contract and then they're supposed to pay 100 million to you, and then they pay 80 million, then they get bankrupt, then this thing become impairment loss. This is a high level explanation of what is happening to the companies when we talk about impairment impacts. So I just wanted to give a very high level explanation on when you see impairment means what. In short is you do something supposed to get back something in value, but then the company cannot pay back. Then based on whatever legal way that you have gone through and it still fail, then it becomes impairment loss, and it will literally impact it from a retained earning perspective. So this is high level, but then regarding the details of what is the impairment impacts they have reported last year, I think maybe Jupan can add a little bit on it.
Yeah, I think okay, so I think Chun Bing explained impairment quite well. So basically you can also link back to how a bank, when they borrow you money, right? Or you lend you money, sorry, then you borrow from them. Then if you somehow got into some issues or troubles, you lost your job and then you couldn't pay back the money. So of course the bank will try their very best to actually refinance your loan, etc., work out that kind of solution. But at the end of the day, if that cannot happen, then you have no money to pay back the bank. The bank has to actually report onto their annual report. Okay, this money I lent out to someone, an individual, and then they are not able to pay it back. They not only cannot pay back the interest, and they also cannot pay back the capital. So that the bank or the company has to record down this loss as an impairment loss, right? So the same goes for service-related companies like UEM Edgenta. Sometimes the company might have paid for some stuff in advance already, and then down the road and during a pandemic where things are not doing that well, some companies may end up holding up, go into bankruptcy, and then Edgenta cannot actually collect payment from them. And then this is the so-called some kind of examples where they have to book the loss. I already carried out the service as per the contract, but the company or the end party that's actually going to pay me went into some problems, and Edgenta cannot collect back the revenue that they have earned, so they have to book a loss into their annual report or their quarterly report, and that will actually constitute to a impairment loss. So I hope we answered your questions. So yeah, you have to check for these kind of losses when times are not so good. Michael Law, have you covered VIS dynamic? No, we have not covered VIS dynamics yet. So yeah, yet another candidate to actually consider in our upcoming Not So Late Night show. Yeah, definitely one of these days you can look into VIS dynamics and also Masterpack. But yeah, I think any other questions that you guys have regarding whatever stocks that you might have on mind, or other questions that you want to ask. But in the meantime, yeah, maybe we'll just, while the questions come in, I'll just talk with Chun Bing how crazy the stock market has actually become. There are a lot of funny things happening in the investment world, and sometimes as in retail investors like for mykayaplus, we really believe that you need to invest in the right company. You need to really understand which company really has the prospect to grow regardless of the condition. Say for example, we will not know what will happen in the future. When will the pandemic totally end? We will not know. But does that mean that you need to keep hold of your cash until you wait for pandemic to be totally over, then you start to invest? So that also does not make sense, right? So at least for us at mykayaplus, really stay focused on, even though pandemic might be worsening or might continue for like this for a few years, but what are the opportunities out there to invest, at least to actually make some gains because these companies, we also found out there are companies out there that are not affected by the pandemic. And these are the companies that we actually pick out, study, and write into a report, which is our Stock Plus 2021. So for those who have subscribed to Stock Plus 2021, you would have gone through the 10 companies that we have written. And coming this weekend, we will actually explain why we choose these 10 companies. And we will answer some of the questions that some of us will want answers. But at the end of the day, no one really know what will happen in the future, but what we can do right now, today, to prepare for what is the worst or what is the prospect that would actually come in the future. Right. So this is our rationale when we come into picking the 10 potential companies, not just for 2021, but for 2022, 2023 as well, when there's a recovery or when some certain trends still stay very strong and can continue to create value and contribute to our lives. So we actually spend a lot of our time to actually come up with this report, study the companies, and then I hope the subscribers are actually happy or delighted that they got hold of the report 1 week earlier than the webinar. And we will be anticipating some tough questions on some companies, especially those companies that have not did really, really well in terms of their share price. Yeah, so we see the questions coming already. So David is saying Cycom not much affected by COVID-19. Have you guys done any research on it? I did look into Cycom before. My concern on Cycom is previously it was still very much relying on the so-called customer service phone, customer service via the phone telecommunications way or method. So for me, that one is a little bit outdated technology. I know the company is trying to pivot into other stuff, but it was a good company in terms of the numbers, the balance sheet, etc. But on the business side, I am still quite 50-50 on it. I want to see the new business vertical grown to a substantial scale before I actually think that it's worth for me to actually look and spend my time deeper onto it or not. Michael Law, will you invest in loss-making startups on Nasdaq? Yes. I will not say totally new startup, but at least I know the business model. I am confident the company can grow. The loss is just basically what they want to spend upfront in terms of R&D, in terms of marketing. So when a company is growing, right, sometimes they need to spend all their profits first to grow in terms of sales, in terms of the client base. So when they do that more than what they earn, naturally the company will book a loss. So you need to case by case study each company, whether you believe the company's business or offerings or products is worth that quality or that kind of capability for them to push out that amount of money to do R&D and also to do marketing. So if you really believe that the company can grow and book a profit, say 5 years time, or even maybe a little bit longer, if you are more high risk kind of investors, then yes, it makes sense to invest in loss-making companies, but you don't go all into it, because during growth phase, anything can happen. Just because it's a good company with good trajectory currently doesn't mean that it won't run into problems in the near term also. So it's about also your sizing your portfolio. High risk company, you have hopes, but you are not so sure yet. You can just buy a bit at a time and monitor it along the way. If it manage to grow within your expectation or even above your expectation, then you can choose to top up. And don't be afraid to actually average up. We always hear people talking about average now, but if it's a good company, still have lots of opportunity to grow. So never be afraid to average up if it's a good company lah. Okay, and yeah, I see that David is very happy with our sharing. Of course, we also appreciate your time. Every time or every week when we do this, we always ask ourselves, our viewers spending quality 1 hour time with us, are we creating value? Are we actually imparting some beneficial sharing to you all? Because it's the internet world, you can choose to watch anything you want, but you choose to actually spend 1 hour of your evening time with us, and we hope that it's a beneficial sharing. And if you do like it, of course, give us a likes, follow us on our Instagram, Facebook, and YouTube, subscribe to our channels, and as always, we will see you guys every week, Thursday, 9 to 10 p.m. And we will definitely put emphasis on the 2 companies that have been highlighted, BIS Dynamics and also Masterpack. So stay tuned for next week's Not So Late Night Show. As always, I hope you guys stay safe in Malaysia, and I will see you next week. Bye-bye.